Centaur Asset Management has achieved compound returns of over 25% per annum on their managed portfolios since they were founded 9 years ago. Roger Williams, Managing Director of Centaur Asset Management, joins us in studio to chat about the company's flexible fund and investment strategy in this global environment. Roger, thanks for your time. I guess the question is, how do you position your fund to perform at its maximum in this environment where uncertainty rules? I was listening to one conversation the other time between a fund manager and one of our journalists in South Africa, and they were talking about how no one still likes cash in this environment, and yet, given the uncertainty, one would imagine you would like to keep your assets perhaps as safe as possible, and of course, cash is the safest.
Yeah, I agree. Cash is the safest, but if you look over time, it's a very costly option to hold longer term. And that's something we always have to take into account, the opportunity cost. And I think the most important thing dominating the South African environment at the moment is it looks like it's probable that the Reserve Bank is going to have to drop interest rates over the next 6 months sometime. And cash is going to get a worse investment, and you have to deploy that. So I've got a bit of cash in my fund. It's 18% currently.
Okay.
I'm looking to deploy that to further up equity content. I think equities are going to remain strong. And also I'm switching some offshore, particularly into Europe, where I like Germany, which I think has been sold off with the problems in Europe, but Germany is a very solid place to be.
Yeah, so you're not joining the foreign head that's rushing for our bonds. You are looking to get you more money into equities. I was looking at your write-up earlier, and you speak of lightening your position on some of the better performing stock. Is that now across the board, or are you looking at particular sectors and themes, and those are driving where you're actually putting the money, not just from a performance perspective?
Yeah, some of our stocks, we bought them 3 years ago, and they've performed exceptionally. For a case in point is Woolworths. We bought it at around 10 Rand, it's over 50 Rand. It may still have a little bit more to go, but I think we're neutralizing our overweight positions and lightening that quite dramatically, and taking some of our better performing and switching it into shares which we think have more upside.
So, I mean, you talk about this, you've seen the industrials and the financials have been very strong, and the cyclicals have been sold off.
Yeah.
And you also chatted a bit about how you see a bit of value in Anglos at the moment, which we agree with. Do you think this sort of diversion between the two indices is going to continue? Do you think there's going to be a reversion to mean, or how do you see it?
I think it's very difficult to call. First of all, I think resources particularly were actually overvalued. If you look at the fundamentals of resources, they're highly risky businesses, often options on the underlying commodities. So they're a lot more risky than something like an SA Breweries or BTI. And I think the disparity, the value disparity that we observe now, a lot of it is justified. So I'm not particularly excited about resources overall. I think there's still a lot of uncertainties. I think they're going to be the worst hurt if there's a very big slowdown in China. And let's say Anglos, I have nibbled a bit. It does look cheap on historic measures. It's still paying a very poor dividend yield. And that really shows you that management are very uncertain of the environment, and they're hogging cash, whereas something like BTI pays a far higher dividend yield, but its P is over 2 times as high.
Yeah, you also speak of looking offshore, which suggests that you're saying the growth here in South Africa is not going to be as good as offshore. Now, perhaps later on we can define what you mean by offshore, is that emerging markets that developed, etc., etc.
Yeah.
But by implication, you're saying growth here in South Africa is not going to be good. At the same time, though, we do know that global uncertainty means probably a weaker rand. So one would imagine companies with offshore exposure would be companies to get into anticipating a weaker rand.
Yeah, I think some offshore stocks. First of all, I think if you look on a portfolio effect, it is good to have offshore exposure.
Sure.
Probably 20 to 25% actually enhances the efficient frontier for a fund.
Yeah.
I don't necessarily think European growth is going to be stronger than South African,
right.
but having said that, the rating gap overseas is very high. For example, you're buying reasonably good quality equities in Germany on 5-6% yields, whereas their bonds are yielding about 1.5%. And really, if you compare the two, the equity risk premium in Europe is very, very high, and that's where the opportunity is more than the growth. And secondly, with the weaker euro, some of the exporters in Europe can do very well.
And what about companies? I see you guys like Richemont. Companies like Richemont, which are, even though it's dual listed between Switzerland and here, you have the majority of your earnings, pretty much all of it, coming from the likes of Europe, Asia, and Americas. That's also got quite a low dividend yield, as they seem to be reinvesting a lot of the cash into growth. Is that something you guys like?
I like Richemont. It seems potentially the cycle is not in their favour.
They've been hit hard. They're down probably 12%.
Yeah, they've been hit hard. What I like about it is that they've got a lot of cash.
Yeah.
They're going to look at share buybacks. If you take out the cash, it's on a P of about 10, which is exceptional value. And I think it's a long-term secular growth story. So I think that's a stock to buy on weakness. It is weak. I think this is a reasonable level to accumulate.
Yeah.
But having said that, the cycle I think the market's saying there's going to be a dramatic slowdown. The market may be right. So I wouldn't go very overweight.
Right.
I have been nibbling, but I think one has to be a bit cautious because it may be worse than one anticipates.
Yeah. And for you, what's the story? Is it emerging markets or is it developed markets? When one looks at the raw numbers, in emerging market terms at least, growth is seen as higher than in developed markets. People are talking about the US, again, probably slowing down. In Europe, we do all know about the problems that are happening in Europe.
Yeah, I think what may happen is emerging markets are going to grow faster than developed markets.
Right.
I think that's definite. But what may actually happen is that emerging markets may grow slower than anticipated. I see India and Brazil are actually growing slower than anticipated. I think Brazil's marginal growth maybe 2%. India's growing at 5%. Growth expectations for South Africa and China are being brought down. And the developed markets may actually do slightly better than anticipated. So it's not always the absolute level of growth. It's actually it's kind of price versus expectations. I think there's potential that the expectations may not be as bad in the developed world.
And the expectations, if you look at what the expectations have been built in, as you mentioned earlier, to the likes of Anglos and Billies and Kumba, the expectations are for still quite a severe correction in commodity prices. You're looking at negative expectations. Do you think it's justified? It's hard to call when you see the numbers coming out of China and the fact that Premier went about this morning or yesterday reiterated the fact that the slowdown, they aren't really getting much in the way of momentum. But the markets are pricing in. You talk about Europe, you've got the Swiss bond yield at what, like 0.5 or something. That's pricing in almost a depression, not so much a recession.
Yeah.
You think it's justified, or?
I think with commodities, the trouble with commodities, there's a hell of a good cycle in the 2000s, and the primary profit producer for the major commodity stocks is iron ore, particularly Billiton and Rio, and lesser extent Anglos. Billiton, it's over 35%, and that their margins are still over 60%. So that's what worries me. That iron ore, there's been a massive supply response. It's not iron is the fourth most plentiful element on earth. So it's not really rare. It's more of a logistic effort.
Constricted,
Right.
To get it to the mills. And that's what worries me. That's why I'm not really positive. Copper, there hasn't been a major supply response. It's a lot more difficult to mine. I'm a lot more positive on copper. So you have to be selective. Another one is oil. Oil's been very good. All the shale gas in the US and worldwide, that may be changing the dynamics. So that's not so good for Billiton, their oil portion. So I think you have to look almost specifically at the minerals that each company mines. But I think it is going to be more difficult. It's going to be difficult.
And in terms of the period of, shall we call it subpar growth, or a period of uncertainty that we're currently facing, what sort of time frames are you working with? I had one of our guests here last week and I was asking them, so when do you see this crisis going out of the way? And you were speaking of, say, maybe 3, 4, 5 years. Where do you stand?
Listen, I think investing is always uncertainty. So, I think
perhaps it's more uncertain than it has been for a long time.
I don't really think so. We're always investing in an environment of uncertainty and maybe slower than expected growth. There's very few times where everything lines up. I think you have to really look at the values and really the cost of capital and which companies can deliver. And so I think this period of uncertainty is indefinite, to be honest. And I don't think I don't really think growth is going to meet expectations. What happened in the 2000s is the world from about 2004 was in a very high growth phase, almost unprecedented in history.
There was certainty growth was coming.
Yeah, but no one expected that. If you said in 2002, would have anyone expected that? But that's created expectations that are too high. South Africa was suddenly growing at 5%. The government or no one did anything to really manifest that growth, and now they think 5% is what we should be doing. I think 3% is a more realistic expectation.
But now, I mean, you guys still see value in equities. You're still very well. I mean, you're not a cash fund. Obviously, you're not paid to sit in the harbour and do nothing. But at the same time, do you see the market as reasonably cheap at these levels?
You have a minute, Roger.
I think what's important, people always go, what's the value, etc., etc. The most important thing is really to look at the interest rate environment. That's what determines the movement in markets. And with interest rates coming down, the money's still going to flow into equities and push returns. And that's really why I'm long equities, because I think it's the best place to be. That's where we're going to earn the highest return. It's not really whether it's cheap or not. I don't think it's that expensive where I'm getting really worried.
It's not a bubble.
It's not a bubble, but I see that's where the returns are going to be, and that's how I'm placing my money.